irresponsibility is easy, while responsibility is hard work and discipline. Over the week, we have discussed the red bat in the capital market. We have discussed real estate investment trust. We have discussed how to recover your unclaimed dividend, looking at the financial report of Security and Exchange Commission (SEC) that says that about 242 billion naira is sitting as unclaimed dividend as at July, June 2025. Now, I started by saying irresponsibility and recklessness is easy, but responsibility and growth is takes a lot. It requires discipline, self-control, and focus. Today, I'll be distinguishing between different classes of assets and why you should hold them. Remember, we have talked about real estate investment trust, REITs, which is owning real estate as an everyday person, becoming a landlord without the burden of tenancy issues, maintenance costs, and all of that. More so, you can also be a landlord from your location. You can be a landlord in abroad. If you're in Nigeria or any other African nation, you can be a landlord. If you're in the US, you can also be a landlord in the UK. So with real estate investment trust, because that is buying real estate in little pieces. It's buying real estate in piecemeal. Yeah, that's the word, in piecemeal, and you'll be getting rental incomes without the burden of maintaining the house and all of those issues. Now, someone reached out to me and said, what's the difference between real estate investment trust, investing in equities, that is shares and stocks, investing in bonds, treasury bills, those are fixed income investments, and buying commodities like gold. Now, so I'll take it this way. Investing in equities gives you passive income. That is when those companies you invested in pay out part of their profit as dividends to the shareholders. Some of them pay quarterly, some of them pay biannually, some pay monthly. That's the real estate investment trust pays monthly. Then bonds is buying into government, giving government the federal government money to embark on some projects or funding their budget, and they're going to give you an interest. The advantage of a bond is the interest is tax exempt. Yes, the interest on the bond is tax exempt, but you don't, and sometimes you earn passive income because some of them they pay out the dividend quarterly, so you can position yourself. That interest you're getting, it can be paid 4 times in a year. But one of the benefits of a bond is tax savings, because you don't pay. You're giving your money, you're funding the government. So in return, they give you tax benefits. Then what is gold? Gold is a rare metal that is used to preserve and protect your money. Over time, the price of gold appreciates. The only time you have value for gold, you get your value for gold, is when you dispose of it. And it's very liquid, it's very easy to dispose. And majorly, you don't encounter commissions. Unlike if you're selling your stock, when you buy, there are charges attached to it. And when you sell, there is commission. Then with the new tax law that talks about capital gain, if you sell above 150 million naira, and you take out the money from the market, you pay tax. But if you reinvest the money as you're selling your stock and you're reinvesting it, it's tax exempt as well. So that's for that. So now let's talk about the difference between gold and stocks. For stocks or REITs, okay, the difference between gold, stock, and real estate investment trust. This is the underlying difference. Gold appreciates in value. It doesn't depreciate. And it is not paper. It can be traded anywhere in the world. It doesn't have that geographical um, boundaries that, oh, I can't spend naira. But if you're with gold anywhere in the world, you can trade it at the current price, or discounted because it's used, slightly discounted because it's used. So the price of gold, let's say a price of 18 karat gold today is 180,000, and you want to sell it tomorrow, you would not get value, because it will be sold, you sell it as a used gold, and the price would be reduced from what you bought it as. So I bought gold today, being the 5th of February, and I want to sell it tomorrow, being the 6th of February. I wouldn't have any value. I would actually lose money. But if I buy my gold bar, chain, whatever it is, on the 5th of February, and in 5 years' time, even in 3 years' time, I want to sell it, I would get it would never be 180,000 I bought it that I will sell, even if it's a used gold, because number one, you have enjoyed the gold, you have been wearing it, it didn't lose value. Then when you want to sell it, you will still sell it at slightly below the prevailing market price when you're selling it. So that's sorted out. So only time you get your value for your gold is when you sell. Unlike shares and real estate investment trusts, you can own that share without selling, and you'll be making passive income once you've chosen very good stocks that have the right fundamentals. Yes. So those are the differences. That's why I say you don't invest in a particular class of assets. You spread your bread on many waters, just like the Bible says. That way you are diversifying your risk. So you have when and yes, you're diversifying your risk. I personally don't believe in keeping hard currency as an investment. No. Perhaps for those that travel and you need to always change dollars, you can keep. But I always believe, put your money to work, no matter how small. Now, other forms of asset is mutual fund. Those are fixed income. Mutual fund, even bond falls under that. Treasury bills, commercial papers. I've explained it in one of the videos. You could just go look it up. So that's it. I hope this helps you to understand and appreciate what you should be investing in. Remember, this year we are gathering gold like dust. You can join. It's never too late to start. The best time to plant a tree was 20 years ago. The next best time is now.